So what we have set up here is a full balance sheet with opening and closing balances, and below that there is some additional information. Now, in a tute or in an exam situation, you have to get certain information, and it may be presented like this. The additional information may be presented like a profit and loss statement. It may just all be textual. The information will be there to do what you need to do with it. Now, when it comes to calculating this stuff and to do a cash flow statement, hopefully this doesn't turn anyone off going into doing postgrad or sort of going off and doing going into professional qualifications. But the CA program, I'm assuming the CPA is much the same. The financial reporting module in the CA program is ASR and ABC combined. Like it is, and I've gone over it, it is the same stuff. It's like, it's obviously upper level to a degree, but it's not that dissimilar. Now they talk about looking through their cash flow stuff. There are in effect 3 ways in which cash flows can be calculated. Now, the first is the formula method, which the textbook goes through. And that will be, you start with a certain amount, you add, if depending on what happens, say with accounts receivable, you add or subtract it, you end up, do a few other things, and you end up with the cash flow receipts from customers, whatever it happens to be. Now, if you think like that and it works for you, we are more than happy for you to do that. My problem, I don't use it, my problem with it is I can never remember what I meant to plus and minus, and if you've got to remember a whole bunch of them, it becomes really difficult to just keep a track of it all. The second method, which obviously gets used in practice, is just you've got spreadsheets. I mean, I'm sure companies aren't sitting there with paper and pen and sort of working this stuff out. This is obviously done through computer systems. The problem you guys have is you don't have a computer sitting there when you're doing the exam. So obviously you can't do it that way. The third method, which is what even the CA program advocate, is what they call the reconstruction method. And what it basically deals with is T accounts. To me, I think a little bit more graphically, even though I cannot draw to save my life, but if you visualize what's going on, it's a lot harder to make a simple mistake. So we absolutely advocate using this sort of approach. But again, whatever approach you use, it gets you the right answer, and then you can use that, knock yourselves out. So, opening balances of all these items, closing balances of all these items. We have some additional information, and hopefully this is obviously quite small, but if you've got your own copy, it's a little bit easier. So we've got information about property, plant and equipment, we've got information about net profit, information about dividends, information about income tax, sales and admin expense, interest expense, cost of goods sold, and sales. From this, we need to extrapolate out a full statement of cash flows. Now, for what you may have to do in the exam, it may be you've got to do a full one of these. It may be you have to do the operating segment. It may be you have to do the investing segment. It may be you have to do the financing segment, but you don't know that before it happens, so you've got to be able to do all of it. Depends on how many marks we've assigned to it and how long we think it will take. Now, in the exam, you're not going to be shown the numbers for obvious reasons. What you're also not likely to be shown is you're not going to be given a template either. Faces drop. However, and this is for those that are here, and this is obviously for those that are actually going to sit down and listen to this at some point in time. Back of AASB 107, it used to be there, I'm assuming it still is, they have a template of a statement of cash flows. Like there's no way not to know what a statement of cash flows look like because you will actually have one in the exam with you. As I said, I haven't looked in the back of 2013, but I'm assuming it is still there. So anyway, set this up, but by the end of your preparation for it, you should have a pretty good idea what goes where. We've got to figure out how we get these numbers. And to do that, we need T accounts. So let's start things off. Receipts from customers. Accounts receivable. Strictly speaking, you don't need a cash T account because it's going to get quite busy, but you need to note somewhere what the cash flows are. So way that you set this up is you can almost do it for every single asset and liability and equity account that you have, set up a T account for them. Once you start getting okay with this, you can realize there are some you don't need to worry about, but at least as you get into the rhythm of things, you can almost set up a T account for every asset and liability account and equity account, and throw in their opening and closing balances. So with accounts receivable, we start with, make sure I put it on the right side. We start with $72,230 and we end with $106,860. So all that I've done there is taking that information from the balance sheet. Nothing tricky with that. We then make sales. Now, the sales that we make, it is better to assume that they all got made as credit sales. Obviously, the reality is that's not going to be the case, but let's just assume they were all credit sales. And the sales, if you go to item 8, sales totaled $301,330. So we'd have $301,330. I've run that into each other a little bit, but you get the point. And we debit accounts receivable $301,330, we credit sales revenue $301,330. Now just eyeballing those figures, there has to be a credit in accounts receivable because just adding up 70 odd and 300 odd does not equal 106,000. So there is a difference and there is a credit amount, and that credit amount, if you sit down and add it up, and I won't do that right here and now, but good to double check these things, is $266,700. $72,230 plus $301,330 minus $266,700. Debit, credit should equal that. And that will be the first thing that we look at with cash, is that is the amount that we receive from customers. And that's just your journal entries. It's just, we know accounts receivable started and closed at certain amounts. We had a sales transaction, debit accounts receivable, credit sales revenue. We then have a gap for account receivable. Obviously something has happened on the credit side. All that we are doing is we're filling that gap. That's it, nothing more, nothing less. That ends up over here. Now, this could be made harder. We could have bad debts expenses. We could have write-offs of bad debts. You could have sales returns. Like there's a lot of ways that could be made more difficult. So just keep an eye on the textbook. Basically, if you don't see it asked in the textbook, and if you don't see it asked in the tutorial work, and if you don't see it asked in prior exams, you're probably not going to come across it, but just be aware that could be made trickier. So that's that number.